Good morning and welcome to Charting the Markets on Monday, the 13th of February. Let's begin by having a look at the economic calendar. At 11:30 p.m. this evening, we've got Australia Westpac Consumer Confidence for February, which is expected to rise to 85.3. And at 11:50 p.m. London time, we've got the Japanese fourth quarter preliminary GDP data. And we expect growth in Japan to come in at 0.2% year on year and at 0.1% quarter on quarter. Now, last week, the UK narrowly avoided being in a recession as fourth quarter UK GDP came in unchanged at 0%. And let's just have a look at the FTSE 100 and what it has done since last week's high at 7,948 on this daily financial bet. Well, it basically came off to 7,850. And then on the back of weaker Asian trading earlier today, it opened up lower again this morning, but since then has recouped most of its lost ground. But from a technical perspective, the FTSE 100 still shows some negative divergence. And what this means is basically that the latest all-time record high we made last week, as I said, at 7,948 on this daily financial bet, had not been confirmed by a higher reading of the relative strength index. And as you can see here at the bottom of the chart, I've got the relative strength index, the RSI, and this is pointing lower. So we've made a series of lower highs here, yet the market has made a series of higher highs since January. And when this happens, something called negative divergence occurs. And this quite often leads to at least a short-term reversal against the trend, but sometimes also pinpoints ahead of time a major reversal in the trend. And what we'll have to see here is whether we only had a short-term drop here to 7,850, and that is already it with regards to the minor reversal being seen here, or whether this is all part of a larger pattern, which could then take us through the December to February uptrend line, which currently comes in at 7,766. And back down towards the January low at 7,708 on this daily financial bet. And this could happen tomorrow, perhaps, on the back of US consumer price inflation data, because in the US, everybody is now, and also world markets, really looking at what that inflation number will be. Will it be a surprise to the upside, in which case equity markets could sell off quite drastically, having risen quite sharply since the beginning of this year. So it'll be interesting to see what will happen tomorrow with regards to that US CPI data release. Now, from a technical perspective, as long as we remain below the all-time high on the FTSE 100 on a daily closing basis this week, the odds are, because of this negative divergence, that we may see a retest of this uptrend line and perhaps also a slide C taking us back to 7,708, the late January low. If that were then to give way, we would form a major topping formation here. And this could then take us back all the way down to the 200-day simply moving average at 7,378 or even lower. But we are not there yet. We'll have to really watch what the market is doing from a technical perspective in the next few days to give us a better indication of what is likely to happen next. And the same really happens with regards to the daily chart on the DAX 40, the German stock index. And as you can see here, we made a one-year high at 15,656 on this daily financial bet last week, then came off and fell through the January to February uptrend line and dipped down very slightly below the 6th and 7th of February lows at 15,272 to 15,245 on Friday, which was retested on this weaker markets we saw earlier today, and retested that low basically at 15,245 and then bounced back again. But now that we've broken through this uptrend line, having seen some negative divergence on the relative strength index here, so that's not confirming the latest price high, that does indicate that if we were to slide through Friday's low at 15,245, we would at the very least head back down again towards this key support area, which is made up of the mid to late January lows between 14,992 and 14,904. So this is really the key support area going forward with regards to the October to February uptrend, which we have to look out for, together with this uptrend line also, which is slightly lower around 14,778. So that is in case of us slipping further in the next few days, what we have to watch out for from a technical perspective, because a break through these support levels would mean that the major top is in place and that we could slide all the way back down again towards the 200-day simple moving average, 13,700. So we'll really have to watch what the CPI data will bring to the table on Tuesday in the US. And talking of which, let's just have a look at the S&P 500. And here what we've seen on this daily financial bet is a high made at the beginning of February at 4,195, which was basically marginally above the higher than the mid-September and also the December highs, as you can see here, between 4,139 and 55. But then we faltered and we came off. Now, what is interesting is that we so far have fallen to 4,051, and that was made on Friday. Then in early morning overnight trading here, we are heading back up again. But we'll have to see whether this is just a zigzag correction, which would mean that we could see further upside, meaning that if we were to bottom out here at above last week's lows and rise above the current February high at 4,195, it is quite likely that we would not only head back up again towards the late August 4,215 high, but also towards the August high at 4,325. So that would be one scenario as long as 4,051 holds. But if we were to fall through that level, for example, on Tuesday with regards to the US CPI data, and basically with that data surprising to the upside, then we are likely to fall through this breached downtrend line, which currently can be seen at 4,018, which should now act as support. But if it doesn't, the next lower support area would be the 2023, so the January to February uptrend line, and also the red line here, the 200-day simply moving average between 3,937 and 3,931. So these would be potential downside targets if we were to fall through 4,051. Now, with regards to the data, US CPI is expected to come in at 0.5% month on month versus minus 0.1% in the previous months. And on a year-to-year basis, we expect to see 6.2% versus 6.5% previously. And core CPI basically expected to come in at plus 0.4% versus plus 0.3%. So these are the numbers we're going to look out for very closely tomorrow in the US session. With regards to the US dollar, the US dollar has tried to stabilize over the last few days, and we can see that having a negative impact on euro dollar. If we look at the daily chart of euro dollar, we can see that last week we slipped through the key support area I have been mentioning over the last few weeks, between 107.66 and 107.15, made up of the mid-December to late December highs and also the early January lows. And we then tried to break through that previous support area because of inverse polarity now acting as resistance, but failed at 107.90 on this daily financial bet last week, and then slipped further to today's low, which was made at 106.56. Now, as long as this resistance area between 107.15 and 107.90 acts as a resistance and caps the currency pair, the odds are that we will slide further in the days and weeks ahead, retest the early December high at 105.95, which is what we're doing at the moment, and then basically slip back down to the next support area, which can be seen between 104.84 and 104.44, made up of the mid-November high, the early December low, and also the 6th of January low. And this is incidentally where we rallied from after the non-farm payrolls data back in January. So it looks as if the euro-dollar chart is actually topping out, and it is likely that we are going to slide further in the days and weeks to come, as long as we stay below 107.90. Moving on to euro sterling, what we can see here is after 5 consecutive days of lower prices, the currency pair actually stabilizing above Friday's 88.24 low and trying to now regain previous resistance, which comes in between 88.77, the late December high, and 88.97, the mid-January high. So that is the resistance area going forward, which is likely to cap this minor advance we're seeing at the moment. And once that continues to cap, if we don't go above 89, that would mean that we would probably see another leg lower take us through this December to February uptrend line, maybe back down again towards the early January low at 87.69, perhaps even towards the January low at 87.22. So I expect the bounce we're seeing at the moment to only last a day or two, perhaps 2 or 3 days, but then to peter out again and another down leg to take shape on this currency pair. Moving on to Japan. Now, what is really interesting here is that we were actually short on our Wednesday trading the trend, and the currency pair did come off all the way down to 129 yen and 80 cents. But then on Friday, it formed this bullish hammer formation. And basically, the currency pair slid on the back of the surprise nomination of Kazuo Ueda as the next Bank of Japan governor. But since then, the US dollar has actually regained some ground overall, but also versus the Japanese yen. And as you can see, this hammer formation, which is a bullish reversal formation on the daily candlestick chart, has been followed by further upside today, taking us to 132.76. Now, if we were to rise above last week's high at 132.90, then we could retest this key resistance area between 133.63, the early December low, and 134.77, the early January high. And this is really key resistance for the long-term downtrend, because if we were to manage to break above 134.77 on a daily charts closing basis, it is very likely that we would not only rise back up towards the 200-day simple moving average at 136.82 here, but probably head all the way back up again towards the 140 yen zone. So it'll be interesting to see whether we can actually break through this key resistance area or not, because if so, we would be forming a major bottoming formation in regards to dollar yen. But as long as we don't, the downside is still being favored. Commodity markets have been impacted by higher yields in US 10-year bonds, for example, but also by a stronger US dollar. And if you look at crude oil, what has happened here is also kind of interesting, because we have been trading in this sideways trading range between slightly above $89 on the upside since mid-November, all the way down to around the $75 mark. So in this basically $15 range since mid-November, and dropped back down towards that $79.04 on this daily financial bet at the beginning of February, but have since then risen again. Today we're coming off slightly on worries that the US Fed will continue to tighten its rates going forward. But basically, as long as we remain above Thursday's low at $82.94, the short-term uptrend should remain intact. And it may take us back towards this key resistance area I've been mentioning for several weeks now, between $87.99 and $89.01. And basically, as long as we stay above the December high at $89.35, as long as we stay below there, we are likely to continue to trade sideways. But if we were to rise and close on a weekly closing basis above $89.35, then further upside is likely to be seen with regards to the price of oil, taking us all the way back again towards the 200-day simple moving average at $95.30, and also the high seen back in October and in November of last year between $98 and $99.06 on this daily financial bet. So interesting times ahead, again on the technical perspective for the price of crude oil. And with regards to gold, what has happened here is we did actually form a top at $1,959 per troy ounce at the beginning of February, have since then come off very, very rapidly. then traded in low volatility in sideways trading range, and last week tried to rise back up again, but failed at $1,890, and then have sort of drifted low over the last few days, so far to $1,853 per troy ounce. The next downside target area is really made up of the high seen sort of between mid and late December high between $1,833 and $1,825. So that would be the next downside target, as long as we remain below last week's high at $1,890. And one last chart I'd like to look at is the chart of natural gas, because we've been saying that it is in a very clearly defined downtrend, and basically kept selling into it. And as you can see here, it was a very profitable trade. But now what we've seen over the last couple of weeks is sideways consolidation. So it is possible that we may have formed at least a minor top at the early February low at $2.36, and that we may be forming a bottoming formation here. But for this to happen, we will really have to rise above $2.69, excuse me, which was the high from last week. And if we do that, the next upside target is this reactive high here, made on the 1st of February at $2.79. So if we were to manage to revert further, I mean, so far we've risen by nearly 10% from the low we've seen at $2.36. But if we were to rise above $2.79 on a weekly closing basis, that would mean that we are likely in the process of forming at least a minor bottom here, and that could take us back up again towards the $3 mark and even higher. But we'll have to see whether we can take out this $2.79 level in the days and weeks ahead. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is @AxelR_IG.